Hello, in this video I'm going to summarize all of the key concepts on financial accounting course that I took. Financial accounting, in a sense, enables us to understand how to read the financial statements of a company. And there are four key financial statements, so let's get into it. And this is how all of those four financial statements are connected. So what are the four? First, balance sheet. Balance sheet is this one. Second one, income statement. It's this one. Third is the shareholders' equity. This one. And then cash flow statement. 4. And they're all connected. And if we understand how they're all connected, and if we understand how they work, then we can really make sense out of all aspects of the financial statements. And once we understand this, we can answer questions like, is this company a high profit margin company, or is it a low profit margin company? Is this company growing because it's borrowing lots of money, or is it growing because it's healthy in its operations? Are the shareholders getting value back, or are the shareholders losing money? So many interesting investment related decisions we can make once we understand how to read financial statements. And these are the four key financial statements. And they're all publicly available. For all public companies, the SEC.gov, the 10Ks are the yearly numbers, and 10Qs are the quarterly numbers where we find all of them. So let's get straight into it. These are the four key statements, and we'll go one by one in each one of them. The essence of each of these is this balance sheet. It starts with the balance sheet. Balance sheet equation. To summarize balance sheet, you can summarize it in one equation. It's this equation: assets equals liability plus shareholders' equity, right? So basically, this is your company. Your company is the assets. Let's say Facebook as a company. Facebook is a company. It has all the assets. How are the assets funded? They're either funded through liability, which is like some sort of a loan through the bank, or they're funded because the shareholders have paid in some money and invested into the company. And once those money comes in, the company can actually buy property, invest in people, build software, and then sell it, right? So any company can be looked into three different aspects, right? It's all the company's assets can be broken down into either liability or equity. And liability is all kinds of debt. Equity is all kinds of capital that investors invest in. And when a company goes bankrupt, the liability stakeholders, like the banks who have given the loan, have the first claim, not the shareholders. So that's another learning. So once you understand the balance sheet, then you see the shareholders' equity can be broken down into these three aspects. Right? Dividends that the company pays, the stock paid in capital, and then the retained earnings. So let's hold for this a little bit. Let's go to the income statement. It's easier to connect. Income statement is basically company does two things. It has revenue. It sells products, so it has revenue or sales, and it has expenses, like it has to pay for the developers in Facebook. It has to pay for the machines. It has to pay for the plant and equipment. So it does expenses and it generates revenue. So revenue minus expenses, income or earnings. These are the same terms: income, earnings, sales or revenue, same terms. So revenue is what you get and expense is what you give, and the difference between the two is income. So this is what the company makes. That income goes and adds itself to the retained earnings. The company makes money, right? That's how the shareholders make money. So it makes money. This income, the net income, is also used into the cash flow statement. So cash flow statement in summary is what's going on in my bank accounts. The reason why we have these two different income statement and cash flow statement is accounting is based on accrual based methodology. It doesn't necessarily take into account the timing of it is not as the same as the one that the bank accounts transactions have. So in this case, revenue is recognized when earned, which is the part of the revenue. But you could sell a product as a company on credit. You might not get any money out of it. So your bank accounts have no change, but you can recognize revenue. So that's why we have these two different types. The transaction happening in your bank are very different than the transactions happening in your sales, in your how quickly you collect the money. Because you can sell a product on credit, you can sell it on cash, but when you sell on credit, there are lots of things happening. You have to collect the money, you have to make sure that the person who you gave services to doesn't default, lots of things. So that's why income statement and cash flow statement gives you two different perspectives. So now we've understood revenue minus expenses income goes into retained earnings. Retained earnings, before it becomes shareholders' equity, the company can decide saying, hey, I'm making money, I'm going to give money to my shareholders. So they can do it by paying dividends, or they can do it by buying shares, buying back shares. They're returning money in some fashion, so they do this. When they do this, it's going to be subtracted from retained earnings, and the remainder of it goes into shareholders' equity. So as you see, as the shareholders' equity goes up, the assets also eventually have to match up, right? This equation has to be balanced. So what do I mean by that? So let's say your assets go up, or let's say your shareholders' equity went up, right? Because let's say your company made much more money than the expense, and it actually it didn't give dividends, didn't do share buybacks, but then your shareholders' equity went up. So in this case, what would happen is that this has to be balanced by an increase in the assets, because this equal to sign, this equation has to be balanced. This accounting equation has to be balanced. So when you have more income, you will probably see it in some sort of a cash asset increasing, because now you have money coming in, so it increases. Similarly, if you lose money, then this also has to go down, right? So if you lose money here, the way you balance this is by subtracting some of the assets, some aspects of the assets, or you could have no change in the asset, but you could have a positive deferred payable account increasing in the liability. So these cancels out. This one also potentially cancels out, right? Because if, let's say, this is much greater than this, then this is going up, this goes up as well. So we'll go into that detail, but overall, the key insight is that income statement is connected to shareholders' equity. Income statement is also connected into cash flow, because the cash flow statement starts with the net income. It starts with the net income, and then it subtracts cash flow from operations, cash flow from investing, cash flow from finance, right? So it does plus and minus, but this document is what's going on in your bank account. So now we understand this, and then cash flow statement, the beginning and the end of the cash flow statement goes into the cash assets. So cash is an asset, so this goes into the assets account. So they're all connected, but they give you a different perspective of what's going on. The income statement gives you the health of what's going on in terms of is my company, if you want to answer the question like, hey, is my operating margin and net profit margin, right, is it high? Meaning, then you can look at the income statement and figure that out, right? Similarly, if you want to find out, hey, are we losing money from the banks every quarter, every year, you look at this one. So different aspects of and different reasons why these are all connected and how they're connected. And now let's go into this plus and minus sign. So for that, we need to understand the T account. T account looks like this. The reason why it says T account, I'm guessing, is because of this T sign here, right? It has debit and then credit, right? Assets increase on debit, they increase their value on debit, and then decrease their value on credit. So this debit and credit, this is another tricky concept. So when we see in our bank accounts, we see what? We see when there's a debit, we see that money goes out of the account. But when we see credit, we see money coming into our account, right? Typically, this is what we see in our bank account. But that's not the same term as debit and credit here. That's the key learning. There's a key learning here that these are T accounts, and then they increase in value or decrease in value based on the type of account they are. And there are two types. If you see the one in blue and the one in black, right? The one in blue increase their value on a debit transaction and decrease their value on a credit transaction. All the remaining in black, right? So these are the three blues: assets, cash, accounts, expenses. All the remaining ones go up in credit and down in debit. So that's the thing to remember. It's not, so the biggest unlearning that needs to happen when you take an accounting class is you don't have to look at your bank account statement and take the debit and credit concept, because that's not how it is, right? So in your bank account, let's say it's your cash account, it goes up by it goes down by debit, right? But in reality, in accounting, cash accounts go up by debit transaction and down by credit. So it's exactly the opposite. So if you remember your bank account and if you invert it, then you're golden, right? But basically you have to unlearn that concept, and then you understand this concept of a T account, and there's debit and credit, and there are these types of accounts. Once you understand what types of accounts they are, what is the nomenclature used for them to go up or down, then you can actually label them. I've labeled them all here, but this is the summary table. This summary table tells you what accounts go up in credit, up in debit, down in credit. These are asset accounts and expenses accounts. Cash is an asset account, so I didn't explicitly write it. So look at all types of cash and asset accounts. So with an A is an asset, with an E is an expense. So these are all expenses, these are all assets. And then the one that goes up in credit and down in debit are the liability, equity, and revenue, right? So liability, equity, revenue, right? These are all that go down in debit. These are all that go up in debit, right? So these are helpful to know, because when you create journal entries or adjusting entries, then they go up and down based on that. But the essence of this is that the accounting equation has to be balanced. The essence to learn is how these are all connected. The essence to learn is what is the value each one provides. Where should you go for to look at, like, let's say if you're looking for how much is my liability or the loan, then loan is here, right? Is my company buying back dividends? Is my company giving dividends? Then you look at your shareholders' equity. Is my company generating more revenue than expenses? Then you look at income statement. Is my company's retained earnings going up or down? Then you look at overall shareholders' equity. And if you want to look at, like, is my assets overall going up or down? Am I profitable? Profits, earnings, income, profits, right? Then you look at here. If you want to find out, hey, what's going on in my bank? Am I losing money? Because if you lose money too long, then you cannot really pay back all of your liability. So that is the sense. And then how it goes up and down is a technical detail. But once we understand these four financial statements, we can make a lot of sense as to, hey, is this company running its business efficiently? And so the concept next I want to introduce is this cash conversion cycle, or the working capital days. So what is cash conversion cycle, right? So three things, right? What happens? Let's say this is the company, right? The company does what? It creates goods, right? And then it sells those goods, and then it collects the money, right? Hopefully in this whole business, it's actually making a positive money. So it creates, it builds goods, it sells goods, and then collects money. These three things, that's it. So when it builds those goods, it creates this thing called inventory, right? When you produce something, right? So that's inventory. When you sell it, then you have to, like, collect that money, which is called accounts receivable. You sell something, most companies don't really take cash up front. Then they have to collect that money even after they've given the service. So once you sell it, then you have to collect the money. Once you collect the money, you have to pay all the people that you depend on. You also, as a company, might buy things from other companies as raw materials and things like that. So you have to then pay back. So you build products, you sell them, and then you pay the people that you need to pay. So if overall, let's say this is now converted to days, and let's say you take 5 days to build and 5 days to sell, and then you take 10 days to give back. So the total is you took 10 days to build and sell, and then you take 10 days to give you all the people that you owe money. So the net of this is 0, right? You took money for 10 days to buy and sell, and then with that money, you were able to pay back only after 10 days. So your cash conversion cycle is 0. Let's say you only had 5 days to pay back, right? Then your cash conversion cycle is 5 days. That means you need 5 days to fund your business. You need money for 5 days. The lower this number, the cash conversion cycle number, the better. That means you can use someone else's money to build products, sell them, and then pay back your people that you owe debt to, and you can still be running the business on someone else's money. So that is cash conversion cycle. In a sense, how long are you taking to build the inventory of goods and products that you need to build, which is this inventory days. How long are you taking to sell it and then collect the money, account receivable days. How long after that are you paying back all the people that you need to pay back for the services that you owe to them? So if if this number is low, that means you're good. So if you're comparing two industries, this is a good ratio. In a sense, I think if you understood the 4 financial statements, you understood these kind of key ratios as to, hey, what is my gross margin, profit margin, what's my net profit margin, what is my cash levels, how much interest coverage do I have, meaning like how high is my income compared to the debt that I have for the year. Can I really make positive cash out of those operations to pay back the debt? That is important. I think understanding the 4 financial statements, understanding and to build that rigor of what are those key ratios to compare one company versus the other. So the other piece to remember is to not compare companies in different domains, because they'll have different capital requirement ratio, different, some might be asset heavy, some might be asset light, some might be having really high power to pay back accounts payable will be quite high in terms of days, like Apple, it takes forever for them to pay back. So then you can find out which company has power. You can compare those two companies to really get a gut feel of, hey, is this company a good company for me to invest in? So we looked at the 4 types of financial statements. We looked at one key ratio, cash conversion cycle or working capital days, but there are many ratios that we need to build as part of looking at these statements to find out, hey, is this company doing well or not? Cash flow, investments, and finance, right? So let's look at the cash flow statement. What happened? How do we build a cash flow statement? The way we build cash flow statement is we take the net income from the income statement as a starting point, and then we make 3 adjustments, 3 major adjustments. Remember that. And why do we do that? Because in income statements is accrual-based accounting. So we might have things that we call it as expense, but we never really paid money from the bank. For example, adding back depreciation, stock compensation, amortization of patents and things like that. You really did not pay anyone money, so but you still can count them as expense and depreciate them and all of that. So you want to add them back. That's the first adjustment. Then you need to remove things that don't belong to the operations part. So there are 3 parts of the cash flow statement. It starts with the net income. The first part is cash flow from operations. The second part is cash flow from investments. The third part is cash flow from finance, right? So you do plus minus, and then you get the new cash flow, net new cash. So these are the 3 sections, and we need to do these 3 adjustments, especially to the cash flow from operations. First, add back those non-cash expenses because you never really paid for them. Remove investments and finances because they should belong in the investments and finance categories. For example, if you buy land or equipment, property, plant, or equipment, and if there is a loss or a gain, then you need to remove them from cash flow from operations and just add them here, right? And then the third is, because of the timing differences, accounts payable and accounts receivable, you might have expenses in revenue and income statement, but you need to adjust them. So if you have an accounts receivable decrease from the previous year to this year, then you add them back to the cash flow from operations. If you have an account receivable increase, then you remove them. Similarly, so basically it's basically saying reflect the reality of what's really going on in the bank, right? If you decrease the accounts receivable, what does that mean? That means you really collected money, right? So when you collected money, that means it's a positive cash, right? You collected more money than what it's your ability to collect is getting better. Similarly, accounts payable, if it increases, then you add that back to the cash flow. It decreases, then you remove it from the cash flow from operations. So once you do those three adjustments, then you are done with the cash flow from operations. Then if you want to continue to build cash flow from investments and finance, the only thing you remember is inflows is positive and outflows is negative, right? So you do those two adjustments. That's what this is. Investments is nothing but all the property, plant, and equipment. That's what belongs in cash flow from investments. Cash flow from finance is about your stock, dividends. This is specifically three things. Stocks, if you buy back stocks, if you issue new stock, if you give dividends, if you take new loans, right? That's all cash flow from finance. So those are the three pieces on how you generate the cash flow statement. This is an important aspect to really generate the cash flow statement well. But this is very helpful to understand how to read it rather than actually to build it. But once you know it, you will know why some of those things are removed and not removed and things like that. And those three sections have a different value. You can make a lot of sense as to, hey, is this operations positive? Is the net operations positive? And then what are they doing? Are they generating money from intake? Are they investing more, acquiring more companies? And you will see the investments go up. If you see that, hey, they take on more loan, then finance activity will go up. If they do dividends, share backs. So this gives you a lot of money as to what they're doing with the money in the bank. Very important. Once you know the income, you can build the cash flow statement, income statement, then cash flow statement. Once you know that, you can add that to the assets cash account here, which there is an entry in assets account for cash. And then you decide, hey, you want to give dividends or not. You can build the stockholders statement, and then you can build the balance sheet overall, right? So we went through different types of accounts, 4 types of balance sheet, 4 types of financial statements, look through what are the operations that happen for the cash flow. And then there's this COGS. What is COGS, right? It's, think about it as cost of operations, right? Like cost of goods. Like what is how much money you're taking to sell. Let's say you Facebook, right? If they sell you $100 worth of services, how much is the cost of goods, right? It could be like just $10 because all they're paying for that $100 of service is maybe internet, the data that they use and the servers that they run, but so it's going to be very low. So the COGS is basically like what is my expense, right? And you can look at all of that in the income statement as well. But basically, when we have to look through the cost, there are many ways to depreciating or using the last in first out or the first in first out, right? So if you use, because every company might have different needs of raw materials, and raw materials costs go up. When you use last in first out, meaning you're saying, hey, whatever the last cost it took for me to build, let's take an example, it might be easier for me to explain. So let's say you build in 2017 10 units, and then each unit took you $10, right? Price per unit. And in 2018 you build another 10 units and each unit took you $20 to build. And 2019 you build another 10 units and it took you $30. So price is increasing, right? And when you use last in first out, you're basically saying, hey, I want to sell the goods that were produced the last at the very first. Versus you say first in first out, I'm saying, hey, what goods I produce at the very first time, I want to sell them first, right? So when you do that, the cost basis is different. This, if you sell, the cost would be $100. But if you sell this, then the cost would be $300. So the expense on this one is lower versus the expense on this one's higher. So if you have lower expense because you're doing FIFO, first in, first out, then you will have higher income. Once you have higher income, you pay more taxes. Similarly, if you do last in, first out, then what will happen is your costs will go up, expenses go up, then income goes down, and then what happens then is you pay less taxes. So depending on how you depreciate your assets, or what kind of rules you use for depreciating or accounting for your cost of goods, it has a big impact. That's another key insight I learned from taking this course, which is there's lots of ability for management to really influence how the accounting statements look. You can change a lot. For example, let's say Southwest Airlines, they decide they're going to spend $5 million in improving their aircraft. They could do it in two different ways. They could say, hey, I'm going to increase my asset because, hey, my equipment got better. Look, asset, equipment account got better. And then I'm going to have an increased depreciation for it over time. And I'm not going to just expense it. Versus Alaska can say, hey, I'm going to just expense this $5 million as like a maintenance expense. And then their income will go down. Profits will go down. They'll pay less taxes. So there's lots of judgment on where what comes in. How quickly do you depreciate? There is a straight line depreciation, right? Which you say, hey, I have a good, I'll just depreciate every year by this much. Versus a double decline depreciation, which just says, hey, I'm going to just depreciate like twice the book value of this product. And so there's lots of things that the management can do, the leadership team in the company can do to influence how the accounts look like. But there's limit to it, because there's auditors that can actually like catch for these things. You can even like do different ways of depreciation for different types of goods and things like that. But you have to be consistent. So auditors really help. There's lots of nuances. So really looking at the company's balance sheet and all the financial statements is very important to really make a sound judgment. If you just look at the total numbers and then say, hey, this is doing well, they could be inflated, right? In this case, when they're using LIFO, last in, first out, what will happen is they will have lower income, right? And their assets would be, would be the lower income, and so what will happen is overall their equity value will not be that high, but their assets will have goods that are highly undervalued, right? Because they are the prices from long time ago. So you'll have to then check when you compare two companies, like, hey, what kind of depreciation schedule they use, how do they do their depreciation, what is their annual cycle. Every company also has a different annual cycle, so not everyone is December 31st, right? So how do you compare what's peak season? So the context around changing this is quite a bit. One other data point is like what you do for accounting for SEC is very different than what the company could do for tax purposes. That's another insight I learned out of this. And there are two different rules and two different bodies. They don't really talk to each other. So take it with a grain of salt when you look at this. It's an important gut feel, but making investment decision purely based on accounts can be misleading. If you don't have the management that you trust, or if they're not consistent over time, and if you see them switching quite a bit, if their cash flows is drying up, and that's where you need to use these skills to do some sort of investigation or some sort of fraud check, right? This is your like check where you say, hey, everything is good or not. So auditors really help. So collection turnover is these are other two ratios I want to talk about. Collection turnover, account receivable days, which we talked about. But collection turnover is basically saying, hey, for the sales that I'm making, right? In a year, how many times I can collect? Let's say I produce one item. If I want to say inventory turnover, meaning in a year, how many times can I put it on the shelf, take it out, put it on the shelf, take it out, put it on the shelf, take it out. The more the better. The quickly you turn over your goods and services, that means your profitability margin continues to stay high. So these are some more ratios. Net sales includes cash sales, credit sales. It subtracts a discount. You remove the returns allowance for the sales, and then you get net sales, right? And there's different types of depreciation schedule. We looked through that. And there's this new concept that really took me a long time, which was bad debt expense, right? So sometimes when you borrow, when you lend, when you sell your products on credit, you have accounts receivable that goes up, right? And so, but certain accounts default. They mean they cannot pay you back, and that is where you have this concept called an allowance, bad debt allowance. Um, which is basically saying, hey, every year the company has to do an estimate that says, hey, how much money am I okay not getting back, because I know that these customers will not pay any money. Like, you might question, like, why would a company approve of a sale to a company that they are not going to get money back from, right? That was the first question I had. But then you never know, right? You can do your best as a company to check credit worthiness of a customer, and especially when you cannot take cash up front. And that was another startling thing for me. Is like, why do you not have to pay cash up front? Every consumer product that we buy as consumers, we pay cash up front. Have you heard about maybe one or two exceptions where when we take blood tests, we ask for an invoice, they send you, they do the services for us, but then we pay them back later? That's one example. But like, for most consumer companies, you pay credit card, or like, you pay debit cash right there, right? So they collect cash up front as soon as the service is given. But companies and businesses, they don't work that way. They have this invoice, and then they pay, and then there's this cycle of collection. So when you do that, there's bound to be certain people that will not pay you. They'll take all the services and not pay you because for whatever reason they were under financial stress. So bad debt expense is important. Basically, bad debt expense, in summary, is an expense. It's an expense. It's an expense that helps you add to your allowances of uncollectible accounts, right? If you have an allowance, you want to add to it. You say, hey, I cannot collect $100 this year. Next year, I anticipate I cannot collect $200. Then you need to add an expense of $100, add to the allowance of bad debt expense. And basically, if you think about bad debt expense is an expense that gets you to add more to your allowance. And write-offs, which basically you've now made up your mind that, hey, out of those $100 that I have in my allowance, I actually needed to use $50 because those 50 people actually said they cannot pay. So those are your write-offs, your aging schedule. You take money out, and then your allowance goes down. So that was an interesting. So basically, these are all different types of accounts. Remember to balance these two. Remember how they go up and down. And remember, the key is, like, when you think about your bank, debit is taking money out, right? It's a cash account, right? But in reality, it's exactly the opposite. And if you start there, then you can actually build all of this map. Then you understand like how it works. But those are intricacies or details. But the key learning from all of this is to understand where to go for this information, and to get a gut feel of, hey, is this company able to pay back the debt that it has? Is there size to profitability? But even that is hard. I looked at a couple of these companies, and it was so hard to realize that, hey, they're just losing money, but their share price is going up. Tesla, for an example. Look at Tesla from 2019 to 2020. It never made money, but the share prices went up. So I don't know how much of this can actually tell you whether the company is actually profitable or will be profitable. Lots of variations, but at least it gives you some educated guidance. And my next adventure into this is to really look at some of these companies and look at how they are. So this is book value, right? Assets book value. And that could be very different than the market cap. So that is another learning, right? So the company can have a book value of $1 billion, but a market cap of $10 billion, right? Meaning there is a PE expansion, meaning that the company is expected to make much more out of the revenues, and so the market's anticipating that, so it's moving up. So my biggest next adventure is to really understand and look back at some of these companies to see if we can spot patterns in terms of how, when some company was just unprofitable, Slack is another one that I'm interested in, and then eventually gets profitable, but the market reacts way ahead maybe. Or I want to look at two examples. One is where the market reacts way ahead and it was right, and one is market reacted way ahead and it was wrong, right? So that'll give us a good lens of like how accounting statements really help us. But in a sense, it's to get into this comfort zone of what are these statements, where do I go to look for this information, and how much weight to give. I think if we get those 2 or 3 key ideas, then I think we are sold and golden. All right, so those were the key learnings from the accounting block. It was great learning. Much more comfortable reading the financial statements, much more comfortable understanding how much value to give and creating my own ratios, understanding the efficiencies of the company, and then really comparing, like how are they allocating money. So that gives you so much more insight, so much more powerful insight. Rather than just reading someone else's independent assessment, you can write your own independent assessment as to how is this company doing on each of these 4 financial statements. Great learning. It was awesome to summarize. Thank you.